Trustees of defined benefit pension schemes face many challenges, managing the ups and downs of investments, calculating the financial impact of changes to life expectancy, as well as keeping up with changes to regulations. One of these changes is the requirement to produce a long-term funding and investment strategy, introduced in the Pensions Act 2021. The legislation doesn't specify a particular endgame plan, but every scheme is thinking about theirs and what it looks like for them. The ultimate goal for both trustees and corporate sponsors is to provide the benefits promised by the employer in the most cost-effective way, and that's where pension risk transfer could be an option. So, who are PIC? We're a specialist insurer, and we only work in pension risk transfer, and we've worked with hundreds of trustee boards to help them secure their members' benefits. If pension risk transfer is something you're considering or want to know more about, this short video helps explain what happens and why, every step of the way. If you have any questions, just drop us a line. Stage 1. Feasibility. At the outset, the biggest concern for most trustees is security. You may be asking yourself, how strong is our sponsoring company? Will it be supporting members in 5-10 years? Our members are living longer. How can we ensure they will receive a pension for life? Can we afford a buy-in or buy-out? So in order to provide the answers, your journey begins with a feasibility analysis. You'll most likely put an internal team together to focus on your endgame strategy. Lots of schemes appoint an advisor to help them manage the process, as there's lots to consider. They'll usually report to a joint working party made up of some trustees and senior company executives. The group will work together to look at different parts of your scheme. These broadly sit under 3 key areas: your assets, your scheme documentation, and your data. These are crucial components to transferring risk. They make sure that you've considered the affordability of transferring risk and have everything ready to move to the next stage. Stage 2. The tender process and selecting a preferred insurer. When you're ready to approach the market, your advisor will approach several insurance companies, offering them the opportunity to bid for the risk transfer business. This part of the process is called the tender process. Trustees generally shortlist 2 or 3 preferred insurers and will score each on price, customer care, track record, financial strength, agility, team credentials, and administrative capability to select a preferred bidder. Once chosen, a period of exclusivity will be entered into to allow both parties to agree contractual terms and finalize the details of the transaction. This usually takes 4 to 6 weeks, after which the contract is signed and the policy is effective. Stage 3. Transition. The tender process now moves into the transition phase. If you choose us as your preferred insurer, we'll become an extension of your team, guiding you through every step of the transition, helping you to verify your data with our data cleansing and member reconciliation processes, and overcome any challenges or outstanding projects you might face along the way. Stage 4. Ongoing support and customer service. Where members transfer across to us, we spend an enormous amount of time and care on delivering outstanding policyholder service and communications. We're incredibly proud of our award-winning customer service. It's why we are the risk transfer partners of some of the UK's largest organisations. That's essentially how it works. But of course, there's plenty of detail behind each part of the process. To discover more, you can download our comprehensive brochure or get in touch with our new business team.